Welcome back to The Disciplined Trader, the podcast where strategy meets self-mastery in trading. I'm Isabel Maria, and today we're diving into a topic that hits home for a lot of traders, especially those just starting out. Episode 3 is all about why retail traders struggle to make money and what you can do to improve your odds in the markets. Trading in financial markets is exciting, full of opportunity, but let's face it, it's also tough. The promise of financial freedom, independence, and the thrill of navigating the markets draws people in. Yet, for many retail traders, consistent profitability remains elusive. Why is that? Well, it all comes down to a combination of psychology, knowledge gaps, risk management mistakes, and structural disadvantages in the market. Let's start with the psychological side. Trading is as much a mental game as it is a technical one. The renowned trader Mark Douglas once said, "The hardest part of trading is not the strategy, it's the mental and emotional part of dealing with the market." And he's right. Fear and greed are two emotions that can derail even the most solid trading plan. Fear might cause you to exit a position too early or hesitate when a good opportunity appears. Greed can push you to overleverage or hold on to losing trades, hoping for a miraculous recovery. I've seen traders refuse to sell a losing stock for months because they were convinced it would bounce back, only to watch their losses grow. Then there's discipline, or the lack of it. Sticking to a trading plan, following your rules, and keeping emotions in check is much easier said than done. Many retail traders deviate from their plan when market volatility spikes or when a news headline rattles their nerves. That lack of discipline leads to inconsistent results and, more often than not, losses. Overtrading is another pitfall. I've personally seen traders, especially beginners, fall into this trap of constantly chasing the market, jumping into trades without a solid reason, often driven by a desire to recover losses or to catch every movement. Overtrading increases transaction costs, magnifies exposure, and burns through your capital faster than you think. But it's not just psychology. Many retail traders simply lack the education and experience needed to navigate the markets effectively. Warren Buffett famously said, "An investor's success depends not on how much he knows, but on how much he is willing to learn." Without ongoing education and proper understanding of market mechanics, retail traders are at a disadvantage compared to institutional players. Consider this: many start trading with minimal training, relying on guesswork or unverified sources. They misinterpret market dynamics, which are influenced by complex factors like economic data, geopolitical events, and market sentiment. Some traders rely solely on charts, ignoring underlying fundamentals, while others focus only on fundamentals and dismiss technical signals. The imbalance leads to misinformed decisions and missed opportunities. Then there's risk management, often the weakest link. Alexander Elder, another market expert, says, "The goal of a trader is to make money, but the goal of a successful trader is to protect the money you already have." Yet many retail traders skip basic risk controls. They don't use stop losses effectively, overleverage their positions, or concentrate their capital in just a few assets. Without proper risk management, even small mistakes can become catastrophic. Now, let's touch on market structure. Retail traders face disadvantages from high-frequency trading and market manipulation. Michael Lewis, in Flash Boys, explained that the market is rigged, but not in a way most people understand. Large institutions use algorithms to exploit minute price differences, moving faster than retail traders can react. Some even engage in spoofing or pump-and-dump schemes. These practices distort signals and can mislead inexperienced traders. Even trading costs and slippage matter. John Murphy reminds us that trading costs, often overlooked by traders, can eat into your profits faster than you might think. Commissions may be lower today, but spreads, financing costs, and slippage still affect outcomes, particularly for active traders who chase frequent trades. And let's not forget the information gap. Retail traders often operate with delayed or limited access to tools and data. Jack Schwager wrote in Market Wizards, "The institutional trader is typically at a significant advantage, having access to more and better information. Delayed data and lack of sophisticated analysis tools put retail traders at a structural disadvantage." Behavioral biases compound all of this. Nobel laureate Daniel Kahneman notes that people are not naturally inclined to make rational decisions. We are wired to make decisions based on intuition, which often leads us astray. Confirmation bias, overconfidence, and recency bias are common traps. Traders cherry-pick data to confirm their beliefs, overestimate their skills, or give too much weight to recent events, often buying at the top and selling at the bottom. To bring this to life, let's consider a case study. Sarah, a retail trader, started with enthusiasm, trading Forex on her laptop after watching online tutorials. Initially, she made small wins and felt confident. But then the market turned volatile. She let fear and greed guide her trades, exiting winners too early and doubling down on losing trades to catch up. Without a clear plan, Sarah overtraded, racking up fees and slippage. After a few months, her account was barely above water. Sarah realized she needed to change. She committed to learning, revisited her strategy, implemented stop losses, limited position sizes, and started keeping a trading journal. Slowly, her discipline improved. She stopped trading impulsively, made more logical decisions, and began to see her capital grow steadily. This example shows that while retail trading is hard, understanding the pitfalls and correcting course can make the difference between failure and consistent performance. So, what's the takeaway? Retail traders struggle because trading is difficult, not impossible. Success requires psychological control, education, disciplined habits, risk management, awareness of market structure, and reflection on behavior. It's a combination of skills, strategy, and mindset. Before we wrap up, here's something for you to think about. What has been your biggest challenge in trading? Fear, greed, discipline, or knowledge? Drop a comment below and let us know. Sharing your experience might help another trader learn from your journey, and we'll feature some of your insights in future episodes. Remember, trading is not just about making money, it's about making consistent, rational decisions, protecting your capital, and growing your edge over time. Thank you for listening to The Disciplined Trader, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading!